Welcome to MoneyWeek Interviews. In this series, I will be speaking with a wide range of fund managers to discuss their views on the market and where investors can find the best opportunities today. In this interview, filmed in central London on the hottest day of the year in the UK, I sat down with Alex Okinajia, CEO of Gore Street Energy, to talk about the energy storage market and Gore Street's plans for growth in this rapidly expanding industry. I do hope you enjoy the interview as much as I did, and please stay tuned for more MoneyWeek interviews. Thank you for joining us, Alex, on what is the hottest day of the year so far in central London.
Thank you for having me.
So can you start by giving us a bit of background about Gore Street, what it does and what role it's going to play in the energy transition?
We founded Gore Street to be material in our fight against climate change. We wanted to be a strong force in an asset class that made a difference to our energy transition. You mentioned the hottest day in the year here in central London. I mean, this is the manifestation of the problems so many people are trying to deal with, and we in our small way are also part of that fight. Gore Street focuses on energy storage assets. These are the critical assets of our energy transition, and we've been investing in them since 2016.
Could you give our viewers a bit more of a background? What is an energy storage asset? What are you buying and how does it help?
Our grids, our energy systems throughout the world are part of this big transition. So we're decommissioning coal, gas, nuclear at a rapid pace, and we're adding in solar and wind. Solar and wind are excellent energy sources, excellent generation sources, and actually in many localities the cheapest form of energy. And they also don't kill the planet. But they're intermittent. So they produce electricity when the sun shines and the wind blows. That's hard for the grids to cope with. They're used to gas and coal and nuclear chugging away, producing electricity consistently. So as we add more and more solar and wind, we need to balance out that solar and wind with energy storage facilities, which allow the grid to be balanced and to function correctly.
So those energy storage facilities, are they essentially just batteries that you turn on?
They are essentially just batteries. So if you are standing at an energy storage facility, one of the ones we own, and we have energy facilities across Britain, Ireland, Germany, Texas, and soon to be California, what you would see is a large amount of shipping containers. They look like shipping containers. And those shipping containers are full of lithium-ion battery cells connected with a whole range of different technology and then connected to the grid.
How big is the overall market here globally?
It's really interesting. When we started investing in energy storage, and we were one of the first movers, we created this asset class for the public investor with our IPO in May 2018. But we were investing from 2016. One of our first assets, Bowlby, which we still own in the north of England, 6 megawatt asset. It was the largest privately owned lithium-ion facility in the UK when we switched it on. It was one of the largest in the world doing grid balancing. Our latest acquisition is 400 megawatt hours in California. So you see this huge growth in the size of these facilities, it going in tandem with the growth of solar and wind. Right now, across Britain, there's about 2,000 megawatts of energy storage assets in operation. The National Grid is forecasting that needs to quadruple over the next period. I recently returned from Japan, where they're probably a few years behind in terms of the UK's story around energy transition. And they're forecasting 10 gigawatts, so 10,000 megawatts by 2030. So these large advanced economies such as the UK, such as Japan, a very rapid build out of energy storage.
So what about in the US with the recently announced Inflation Reduction Act? How is that changing the market?
It's a dramatic game changer, and it's a really interesting thing. I think I've always said to be a good investor in renewables, and I've been investing in renewables for a very long time, you need to understand finance. But you also need to understand technology. You need to understand the technology that you're building. And you also need to understand policy. So those three things that come together in a Venn diagram that you should sit at the middle of. What the US did with the Inflation Reduction Act was put in place a policy which incentivizes us to build. So we have assets in operation in Texas, in construction in Texas, and in construction in California. And the day we switch those assets on, we'll receive 30% of our capex back from the federal government. Now, we operate in a worldwide supply chain where prices are pretty similar between the US and Germany and Ireland and GB to have assets built. So that's a big driver if we can buy the same type of solution to be built at the same price, but in the US we get 30% of our investment back. that leads to some considerable flows heading to the US rather than other places.
So it's effectively 30% cheaper to build in the US than it is anywhere else in the world.
It is.
Yeah. So what about the UK then? Where does the UK sit in all of this?
So the UK has been the market leader. UK traditionally has had a very advanced set of energy policies, has a very advanced ideas around how the energy system should be organized. UK is the leader in offshore wind, right? It really drove the offshore wind. To be honest, it drove the offshore wind because of a bad policy, which was not building onshore wind. But by building offshore wind, they became the world leader. It has been the leader in energy storage as well. So from about 2016 to about 2019, the UK, Britain really, that's the grid, England, Scotland and Wales, was adding more energy storage than anywhere else in the world because of the way the market was set up. The market was set up to allow asset owners such as ourselves to build assets, provide a critical service and make good returns on the back of it.
So do you think that it's no longer as attractive as it once was?
The UK is a very attractive market and it will remain a very attractive market and one of our core investment targets. Gore Street, though, back in 2019, we made a decision that diversification of our portfolio across multiple markets was absolutely the right thing to do for our shareholders. So in 2019, we moved into the Irish market. Similar market in some ways, but fundamentally a different energy system. And we're now one of the most significant players in that market. We moved into the German market very early last year. We moved into the Texas market early last year. And early this year, we moved into the Californian market. So all those markets have very interesting characteristics. They're all driven by the same investment thesis, which is you continue to add more and more solar and wind to your grid. You need storage to balance it off. We work with the same supply chain, so therefore we can deliver the same investment thesis, but with uncorrelated revenues. These revenues in each of these markets are not affected by each other. So the UK, GB, remains a very strong market for us, but we see huge growth in California, Texas, Ireland, and mainland Europe.
Could you put a figure on the total market potential here?
Oh, yeah. I think we could see 10 gigawatts of storage over the next 10 to 15 years. There's 2 gigawatts now.
Compared to 2 gigawatts now.
2 gigawatts now. So we're about, I think we're about the number 2 player in the GB market in terms of capacity. We obviously have a large international portfolio as well. We'll aim to maintain that as we'll grow with the market. But in terms of big focus, I would think we're very focused on the Californian opportunity, Texas, Ireland and Germany.
But you say 10 gigawatt globally. I mean, that's
10 gigawatts in GB.
In GB alone. Okay. There's other things going on in the energy mix, and storage and renewables are just really part of the solution. Do you think there's always going to be a market for fossil fuels somewhere in the mix because renewables are so intermittent and batteries are quite big and require a lot of resources?
There's a lot in that question. Before COVID, if I can take a moment, I would have answered that question by saying society needs a graduated process to remove fossil fuels from our equation. Mm-hmm. Some of the things that this society did in COVID were obviously very extreme, and we seem to manage with them. It is clear, again, to your opening point around the hottest day, that we have a climate emergency. The weather is not normal. Right now in Texas, our assets are providing a really critical service to the grid and generating very significant revenue from that critical service because Texas is dealing with extreme heat. But it also dealt with extreme heat last summer. At what point does extreme heat actually just become the weather? So for sure, society takes a while to be able to replace what is a very energy dense and useful commodity, petrol and gas, but it is destroying this world. And so I think there is a tipping point when people look at that destruction and say, we just can't take that cost. But when we come down to the narrow focus, what can we do as individuals? What can we do as investors? What can we do as companies? Gore Street is focused on energy storage. Absolutely, we think it's a critical asset class in our energy transition. But there is, of course, many other levers to pull. And we need to pull all of them. Really bright people are looking at things like hydrogen. Could hydrogen be a mechanism to help decarbonize our society? One of the areas that we haven't focused on enough is heat, right? And we'll see it again as we come into winter. We're dependent on gas. How do we decarbonize heat? We still haven't decarbonized transport, right? Transport, we're still, EVs, I think, is absolutely, it's going to replace fossil fuel cars for sure, but that's still a big process. Shipping, a whole range of different things. So for sure, we can't just look at one asset and say, this is the white knight, this will solve all our problems. We need to be addressing very particular problems we face in our energy system and addressing them with the right solution. With energy storage, we're addressing one aspect of that energy transition problem.
You mentioned a bit earlier that you started your first asset was 6 megawatts, I believe, and you're doing now 400. I'd be curious to know how the battery technology is improving to allow you to deliver that increase in capacity. And I'm assuming it's not, the space for the 400 is not exactly the same as the...
It's not, yeah.
But you're getting more out of every battery. How has that changed in the past few years? How is that going to change? And how is that going to change the market?
So Gore Street, we take a position that we're what we call technology agnostic. So what does that mean? Even though all of our assets, and so we own 1,200 megawatts of assets across the globe, are lithium-ion batteries. Why are they lithium-ion batteries? It's a very well understood technology. It's been around for a very long time. The large Asian manufacturers are driving really significant capacity increase in their manufacturing base. Not so much doing it for energy storage, they're doing it to replace every combustion engine in a car with an EV. That's the driver, right? But that driver has allowed really significant companies, Samsungs, the LG Chems, the Mitsubishis, who are very happy to partner with because they can give us good guarantees that the system will last for 20 years and it will last at a certain rate, to really invest in that manufacturing expertise. So we saw really significant declines in our solutions up to about 2020. From 2020 to now, we saw some really significant increases. I would say that is driven not so much by energy storage, but by the inflationary regime we're in. There's a huge amount of pressures on supply chains generally. We don't have to choose lithium-ion. We will choose a solution backed up by a technology for what the market needs. Right now, lithium-ion, because of its supply base and because of its cost, is absolutely the right solution for us to use. But we've in the past looked at a range of different things.
Are you considering other things now? I'm curious to see what is there out there, what could change, what's the future looking like for this, an integral asset class really?
What's really interesting about energy storage, and I was an investor in solar and wind for many years, from about 2006 on. You build and own a solar plant or a wind plant, you produce electrons and you sell electrons. As a business model, you hope that the price you sell your electrons for is more than the cost of delivering those electrons, including your capex. In energy storage, it's a little bit different. Our assets are doing about 20 to 25 different types of things. Our assets can be 50% full of electricity, which makes them either a consumer or a generator, depending on what the grid needs. We can also trade electricity. We can provide backup power. We can also balance the grid. So there's a really interesting group of business models associated with energy storage, which gives you this very interesting intellectual challenge and a complexity challenge, but one that also allows us to deliver very strong returns. Over the last 4 years, we've been averaging 13% unlevered returns in the fund on the basis of an infrastructure, a hard asset. And so that's we think, a very strong track record, but one that's driven by us addressing the complexity of energy storage. And that complexity has multiple business models with it.
So that, I think, that takes us nicely on to how you make money.
Yeah.
You said there is energy trading, energy storage, balancing the grid. How do you make money from storing energy?
Yeah. So, and this comes back to why was Britain the leader for so many years in energy storage? Our biggest customers are the grid operators, right? So the people who manage our grids. In Britain, that's the National Grid. In Ireland, it's EirGrid. Texas, it's something called ERCOT, California, Kaiser. These grid operators make sure that the electrons are moving around correctly to where they're needed to be, and they're moving at the right time and the right frequency. So the grid operator then has a responsibility here in the UK to the government to make sure the grid continues to function. And one of the key things about its functioning is that it's balanced, i.e. that the grid can never store electricity. So it always has to be in balance, always has to keep the electricity moving. And somebody say there's a huge amount of a windy day on the North Sea, much more electricity is going to be generated from the offshore wind, or a very sunny day, or a very cloudy day. Those imbalances, which are kind of minute to minute, our systems, especially with lithium ion, are very well situated to cope because lithium ion can respond very fast. So we're 50% full of electricity. The national grid will ping us and say, consume, generate, and we will keep the grid in balance. And for that service, we will charge them an hourly rate by the amount of megawatts that we have for a period of time. So we're participating in auctions every day for different forms of grid balancing. We're also then doing trading. So we will see if there is we believe a very high level of demand for electricity the next day. We will drop out of grid balancing. We'll fill up our facility with 100% electricity and we'll deliver it at the peak the next day.
It's worth mentioning here that on some days, on very windy days, very sunny days, the price of electricity can dip below zero.
Yeah.
And I guess at that point, you then decide, we're going to buy lots of energy and store it in our facilities.
We'll actually even charge people to take the electricity because it's below zero.
Okay, so you charge people to take it off you?
Yeah.
Okay, so this is a quirk of the electricity system that we have today.
It's to do with the fact that we don't, when you build solar and wind, you have a very high level of forecast over a year. You know how much electricity that facility will generate over a year, and it's very, very stable. But it's not stable half an hour to half an hour, right? And so wind overall is more blowy at night, right? So at times of very high storms in the winter, at the middle of the night, when you might not be using that electricity across your system, you might be generating a whole load of electricity. That electricity has to go somewhere. It can't stay on the transmission network. So our facilities are coped then to take that electricity.
Surely we're wasting lots of electricity.
No. I think there has been always a problem with solar and wind, which is called curtailment, which is not, to be honest, the problem of solar and wind. It's the problem of the grid. Right? We want the solar and wind assets to generate the electricity, but we also need the grid to be set up to take it. And so energy storage is a critical part of setting up the grid to take it. Another critical part, which you might have seen in the press a lot, is transmission lines and the like. So the government talking to the national grid about building more transmission and who's going to fund that, how that works. So solar and wind has probably outpaced a little bit the investment in the actual transmission side. Gore Street is part of that side of the equation. We're helping the transmission network deliver electricity in a safe, clean fashion.
So there is going to be a cost to the consumer for doing this. However, I'm assuming the cost is going to be a lot less than paying extortionate prices to import electricity or oil and gas.
I mean, even without taking into account the cost to our environment of burning fossil fuels, right, which, we have over the last 150 years decided not to account for that cost, right? And we can see dramatically the effect of that cost now mounting up as every day goes by. But, we shouldn't be subject to geopolitical events which make people, make it unaffordable for people to heat their home or just turn their lights on. Gas prices go up, electricity prices go up. Energy security should be and is a key focus of every government. And energy security in the end will be enabled by us having generation in the country where we can control it.
So to bring it back to Gore Street and the investment opportunity, the trust is trading at a discount of around 27%, I saw this morning. Why do you think the market is not giving the company the premium, valuing the assets correctly?
For our history, so we IPO'd back in May 2018. The vast majority of that time, we've been trading at a premium. Yeah. And so I think the market recognized the value that we were building. We grew very, very heavily. And I believe that we've done exactly the things that we said we would do to the market. We consistently grow the portfolio size, both in megawatts, but also in energy systems. So we continue to diversify. We continue to hit our targets in terms of revenue and cost per megawatt installed. What we saw from about last September, and without making any political comments on some of the events of last September, is we saw a very strong macro environment change. That macro environment change was in the interest rate environment. And so we have 5 years of paying dividends and target dividends. We set our dividend at a 7 to 7.5p of our NAV. But in a very high interest rate environment where potentially some investors can invest in government bonds, they will move to that, right? So that for sure, I think, has weighed on the stock. I think if I look at some of our peer group have missed some revenue targets and had delays in their projects, and so there's generally a kind of a absence of momentum, I would say, across the sector. We continue to drive really strong performance in revenue. We continue to drive really strong performance in operational metrics. We announced our annual results during the summer, and we put out our quarter results just a few days ago, and they showed that our revenues are best in class driven by our diversified portfolio, and best in class in terms of operational performance. And so we will continue to do that. This is a critical asset class. We are I believe, the trust which is best positioned to profit from that energy transition. We're the only player, not even considering our listed peers, who is operating in 4 different energy systems, soon to be 5. I think that's a really interesting place for us to play, because it means at this level of portfolio, we can say, well, we want more in GB, do you want more in Ireland, Texas, Germany, California, and move our portfolio around to be able to best deliver returns to our investors. For sure, we would, of course, like to see the discount widen. We think it's not reflective of value. It's not reflective of our track record. But our job in narrowing that discount is by continuing to hit the targets that we've set for ourselves.
I'm curious about the interest rate environment that's changed. You said people go out and buy a bond now at 4 or 5% instead of buying equities. Has that changed the way you approach investments at all?
Absolutely. In that we have a very healthy balance sheet. As we sit here today, we've got about 94 million in cash and basically de minimis amount of debt. So the investment committee has taken a very appropriately conservative perspective on how much debt we should have at this point in the cycle at these level of rates. So you can borrow in the corporate market probably about 300 over, so it's kind of fully loaded, about 7-8%. So you need to be very thoughtful about taking that money down.
So that's 300 basis points over the treasury rate, or was that gilt rate cut?
Yeah. So we are adding more, because we have a very healthy, huge balance sheet, but with no debt. We are adding some debt. We're adding it appropriately. We'll add some debt at the project level in California, because we have in the Californian market, you have what's called a resource adequacy contract, which is about 15 years and 40% of revenue. So something you can easily secure, right? So we can borrow against that. We're adding some more debt at the fund level, but we are very careful about how that debt is added. We are fully funded for our portfolio in between equity and availability of debt, and we will continue to build out of that portfolio. Right now, we have circa 500 megawatts in operation or energization. We'll get to over 800 megawatts by the end of next year.
And that's all fully funded. That construction's all fully funded here.
Yeah, fully funded through our debt, the availability of debt, and the equity and the cash we have on hand. And so we're focused on that, right? And we're also focused on where best in that portfolio to expand facilities or slow down facilities. That portfolio optimization becomes really important at this level.
I'm sort of interested in, obviously, the equity route with the trust trading at a discount is sort of shut off. Have you started to pull back from, are you having to rein in growth expectations over, I'm sort of thinking here, 5-10 years time, or is that something you'll think about when you've got through your current portfolio?
No, we're continuing to look at opportunities, right? But we're continuing to look at opportunities across the portfolio. So we don't need to own all of our assets if we see a good opportunity to exit an asset, and we could recycle that cash somewhere else, right? So we're not like, we love our assets. We think our assets are great. They're doing a critical job, but we're also happy to sell our assets at a profit and move that cash.
Is there that opportunity there?
Absolutely.
People are looking to buy them at a premium.
Yeah, absolutely. The majority of the investors in our space are not in the public markets, right? So, they will have allocations over 10, 20 years, right? Rather than the public market, which could move their shareholding on a daily basis, right? So we're still focused on growth. We have a very healthy pipeline in all the markets that we're operating in, and we'll make decisions about that optimization. We're not at this point, though, assuming that we'll be able to go and raise equity in the public markets for a while. That will change. It will change with the interest rate environment. And I also think it will change as the market realizes that over the 5 years of Gore Street's existence, it's consistently done what we said we would do while building, I think, the best-in-class portfolio available to the public investor. So, no, operating a strong pipeline, but focused on our portfolio build-out. That will continue to generate really good cash for our investors. And we have a lot of assets coming on stream over the pretty short term.
And you mentioned with your total return, what you provided for investors. How do you approach allocating an appropriate amount to the dividend, but also investing enough for growth in the future without jeopardizing one or the other?
Our dividend policy, is set in with the board, with our shareholders. We made our last fundraise, which was April last year. So we went out to market. We raised £150 million. We were significantly oversubscribed on that raise. And during that raise process, the dialogue we had with our investors was, by bringing on this chunk of new capital, which will be invested in projects which take 6 to 24 months to bring to cash flow, we will have a change in terms of money going to dividends, money going internally. And so the decision which the board and the manager and our shareholders made was continue to go for growth, right? So we have 5 years of hitting our dividend target. We aim, of course, to maintain that. We have more and more assets coming on stream. We have this very interesting tipping point where we're going from 300 megawatts to 800 megawatts in not that long a period, right? So we have really significant more cash flow coming through from these assets, all very well diversified. So that cash flow is totally fine for our needs. It won't necessarily generate enough cash flow that we go and do another very big project, right? So, Big Rock, our Californian project, 200 megawatts, 400 megawatt hours, it's a $200 million investment from us, right? So we would need to raise new equity for that type of activity.
Would you use debt at the moment then?
We will, as I said, we have a very strong balance sheet with de minimis amount of debt. We will start layering in the appropriate level of debt, but we will maintain a pretty low ratio of debt.
So I think final question, where would you like to see Gore Street in 5 years, 10 years time? Keep growing? What sort of size are we looking at ultimately?
So what we've done in Gore Street, unlike our peers, we made a decision that we would start insourcing a lot of the critical parts of our value chain. So we have a procurement group, we have an asset management group, construction group, commercialization group. Most of our colleagues are engineers and technologists and project managers, not boring finance guys like myself. And that insourcing has meant that we have a very tight control of our assets, right? We can deliver superior cost per megawatt installed and superior revenue per megawatt installed. And I believe we will continue growing that ownership of all aspects of energy storage. I think we're the preeminent energy storage player. We have a very large portfolio operating in 5 different grids, delivering best-in-class revenue, and we'll do so by continuing to own all the aspects of the value chain. So I think we have a very strong future on that basis.
Well, that's a great point to end. Thank you very much for your time today.
Thank you.